Okay, so if I were to wind the clock back and start my investing journey all over again, here are the 5 mistakes that I would make sure that I avoid in order to ensure that my long-term returns don't suffer. Do bear in mind though that this video is just for educational purposes only and should not be construed as financial advice. Nothing that I share within this video is an investment recommendation, and be sure to always go and do your own research before you go on to make an investing decision. So in no particular order, let's start off with mistake number 1, which is not using a tax advantage account.
Okay, so over in the UK, you have 2 types of investment accounts, a general investment account and a stocks and shares ISA account. And here's how they work in practice. We have one jar here, which is your general investment account, and then a second jar, which is your stocks and shares ISA account. And I've got a bunch of marbles, and let's say that each marble represents £1,000. Now, you can fill up both of these accounts, but with the stocks and shares ISA account, you can only put in 20 marbles or £20,000 per tax year. Whereas with the general investment account, you can put in as many marbles as you like. However, here's the big difference. With the ISA account, once those marbles have been put in, they are all yours to keep, so we can put those over to one side. But with your general investment account, it works a little bit differently because you are subject to both capital gains tax and dividend tax too, which is where the old HMRC jar comes into play. Because on disposal of the assets within your general investment account, if it's above your personal allowance, or even indeed if you're paid dividends above that of your personal allowance, well, you will need to take out some of those marbles and hand them over to HMRC. And I'll leave some links down in the description below so you can calculate your own tax liability if you are using a general investment account. It's the reason why I've personally always used the stocks and shares ISA account over the general investment account, because I don't have to pay any tax on it now or in the future either, providing they don't change any of the rules. Now, if I were ever in a position that I could invest more than my tax-free allowance of £20,000 per year, at that point, I would then potentially consider a general investment account and the other types of investment options that are available to me. But as of right now, because I've not yet filled up my £20,000 annual allowance within the ISA account, well, I'm going to continue to use it, especially because it's so tax efficient to do so. And you can look to open a stocks and shares ISA account or a general investment account, just depending on what your preferences are and personal circumstances, on apps like Trading 212. So I decided to reach out to them and they kindly agreed to sponsor this video. And if you click on the link down in the description below and open an account with Trading 212, they're offering all of my subscribers one free share valued up to £100. Or if you've opened an account within the past 10 days and if you use a promo code Mitch, they'll also still offer you that one free share valued up to £100. All you need to do is deposit £1 into the account. So be sure to use that link if you want to get your investment portfolio started with Trading 212, but be sure to stay tuned because the second investing mistake that I made was not matching my holdings to my risk appetite.
Everybody has their own unique relationship with their risk appetite, and there are many different factors at play that determine what that risk appetite is. Things like your age, your financial position, your investment time horizon, and your investment objectives. And the holdings that you have within your portfolio should be aligned to that risk appetite that you have. But when I first started out investing, I probably got my investment holdings a little bit misaligned with my overall risk appetite. And that was largely due to my inexperience at the time, because it was the first time that I'd ever made an investment at all, let alone an investment in the stock market and into my investment portfolio, when I first started out in 2017 with just £400. And from that £400, I'd split it up into 3 areas. I'd put £200 towards an S&P 500 ETF, I'd put £100 towards an 80% equity fund, and then the final £100 into a UK investment grade bond fund. Now, from an allocation standpoint, that was £280 into equities and £120 into bonds, making a portfolio of a 70-30 stock bond split. Now, there's absolutely nothing wrong with any of those funds, and there's absolutely nothing wrong with having a 70-30 stock bond split as your investment portfolio, but investing and your risk appetite all comes down to your own personal circumstances and your own personal preferences. And for me personally, I felt that 70-30 stock bond split was a little bit misaligned to my risk appetite and my investment objectives. And after about 8 months, I did start to realize that, and I felt like I could have a slightly more aggressive approach to my overall investments based on the risk appetite factors which we discussed earlier. So I decided to make a change. I moved 100% of my investment portfolio across into equity markets, particularly the US stock market, along with having some global exposure too, which I felt fitted my own personal risk appetite and my own investment objectives a little better. And I'm certainly glad that I made that choice, because whilst the UK investment grade bond has returned 18% in the last decade, the other fund that I'd invested in, which was the S&P 500 ETF, had a cumulative return of 231.26%. And look, this doesn't mean that I won't ever go back to a bond allocation at some point in the future, because in actual fact, when I become a little bit older, I'm starting to approach retirement age and I want to kind of de-risk my investment portfolio, then chances are I may be looking for lower risk assets to be able to invest in. For me personally, it all comes down to create an investment portfolio that very much aligns to what that risk appetite is and what those investment objectives are too. So it's important to go away and do your own research in order to ensure that you have that level of alignment too. Now, the next mistake is thankfully one that I haven't really made, because I've been using a low-cost broker in the form of Trading 212, and you're probably going to know where I'm heading with this next, and that is to completely avoid paying high fees for your account and your investments. This is one of the most important mistakes to avoid, because if you pay too much in fees, that will massively hurt the long-term returns and the value of your investment portfolio. Most people don't realize it, but fees are almost like the silent killer of an investment portfolio's value. And most people don't ever realize it unless you go on to physically work out the numbers. They're almost like what an unused monthly subscription is to your bank account, especially if you don't even realize you're paying for it. So I'm here to share some of that information so you have somewhat of an idea of what could possibly happen if you don't have that oversight on fees associated with investing. The Vanguard have put out a very helpful article which looked at a £100,000 investment portfolio invested over 30 years, comparing 4 different fee structures. They also assumed a hypothetical return on investment of 6% per year too. And they concluded in the best case scenario, if you paid just 0.1% in fees over that investing time horizon, you would have ended up with a portfolio size of £557,383. If, however, you increase those fees to 0.7%, your portfolio is going to go down to £465,899. Go up to 1.3% a year in fees, and you're down to £389,000. And with fees at 2% per year, your portfolio would be valued at just £317,000. Seemingly insignificant number, but comparing the range of fees, which is just a difference of 1.9% from the best and worst scenario presented, you would have ended up with a portfolio 43% lower in value, or the equivalent to about £240,000 less. It's vitally important that you pick the right investment platform, you pick the right investment products, and you kind of do so in a way where the fees are kind of considered too. Now, whilst we're on the topic of fees, let me explain a handful of the common fees that you might want to look out for. So first up, you have account fees. These are the fees that are just associated with having an account with a broker. And they can either be charged as a nominal fee, i.e. you pay like a monthly subscription, or alternatively, they can be priced as a percentage of the value of your investment portfolio. You can also sometimes have commission fees, which are the fees that the broker charges in order to make the investment on your behalf. And again, some brokers will charge a nominal fee of £1 amount, or sometimes it will be a percentage of the value of the transaction. You also have fund fees, which are typically associated with something called an exchange traded fund, or ETF for short. And these ETFs typically mirror broader indexes like the S&P 500 or the FTSE 100. Now, these fees are associated with the management of the fund and are typically expressed as an ongoing charge figure, or an OCF. If I just grab my phone and head on to the Trading 212 app and look at the S&P 500 ETF just as an example, and if I just scroll down, if you go into instrument details and then you scroll down, you'll be able to see the key information document, and if you scroll down slightly over on the left-hand side, hopefully you guys can see that, you can see the ongoing charges, which is 0.07% for the S&P 500 fund. Now, each fund charges may differ just depending on the provider, so be sure to check that key information document for each fund that you're looking to invest in. You also have FX fees, which are associated with buying foreign investments. So obviously, I'm based in the UK. If I were to go on to buy Apple stock, which is obviously an American company, I need to purchase those shares with my Great British pounds, but I need to convert them into US dollars in order to buy the shares. So if I just click on buy, and let's just say, let's just say I'm going to buy a fraction of a share because I haven't got any free funds in my account. You can see there is an FX fee of 9 pence for this £57.51 transaction, which is an FX fee of 0.15%. There are, of course, other fees to be mindful of when you are investing, so be sure to just check out the broker's website that you're using in order to ensure that you're fully up to speed with all of the fees. If you do open an account with Trading212 though, all of the fees are listed in their terms and fees section on their website, which I'll also leave a link to down in the description below. Now, fees are a big one, but another big mistake that investors also make is buying based on past performance. This is probably one of the easiest traps, especially for newer investors to fall into. Nvidia, Apple, Amazon, Meta, Microsoft, Alphabet, also known as Google, and Tesla are the top 7 companies in the United States of America by market capitalization. And they're also known as the Magnificent Seven. And the reason why they're so magnificent is because the returns that they've provided in recent history have been pretty phenomenal. Just in the past 12 months, here are the returns of these 7 stocks. Now that's extremely impressive, and on the surface of things, you can kind of understand why a newer investor might just jump into those stocks, assuming that that past performance may also carry through to the future as well. But if you roll back the clock just to 2010, the top 7 companies in the United States of America were not the same 7 stocks that we see today. And in actual fact, on that list, only Apple, Microsoft, and Google feature in it. Roll back the clock another 10 years back to the year 2000, and only Microsoft feature. Another 10 years back to 1990, and not a single one of the Magnificent 7 stocks today feature in that list. Now, the reason why I reference that and it's so important is because within the space of just 35 years, which could very much be your investment time horizon, the stocks that have performed good 35 years ago are not in the same list of high-performing companies that we see today. And 35 years into the future, those 7 stocks may be completely different again. So again, this comes into a broader investment strategy, which should be aligned to your risk appetite, and that risk appetite should feed into how diversified you would like that investment portfolio to be. But the final mistake could be the most detrimental to your long-term investment performance, and that is short-term thinking. In my opinion, one of the worst things that you can do when you're investing into the stock market is to think in short time intervals. Let me just show you the first 3 years of my own investing journey between 2017 and 2020. And at the time, I was consistently investing £400 every single month. From the chart, you can see it gradually went up in value over time. Most of that value was definitely coming from the contributions that I was making to the portfolio, along with a little bit of positive market returns too. But within this chart, there were also some big dips within the value of the portfolio during that period of time. If we say zoom in to Q1 2020, you can see my portfolio dropped in value from 13,100 to just £12,000. That's over £1,000 in value that the portfolio lost just in the space of a week. Fast forward again to 2021, where I went from 17,800 to just 16,500 in the space of just a few weeks. Another dip in portfolio value to the tune of about 1,300 quid. At this point, I could have said, look, this investing stuff isn't for me. It carries too much risk and the value of my investment portfolio is fluctuating a little bit too much. But I always kind of refer back to that old quote from Warren Buffett where he said, until you can manage your emotions, don't expect to manage money. And my ability to manage my emotions during that time and kind of realize that my investment time horizon wasn't what was going on within the next few days or the next few weeks, and actually it was over a 30-year period of time, meant that I kind of took my mindset away from short-term thinking and started thinking a little bit more longer term instead. Because the reality is financial markets are a little bit of a roller coaster. On some years they're up, and on other years they're down. It's just part and parcel of being an investor. It's why you always hear the phrases, your capital is at risk and past performance isn't indicative of future results. And that's because nobody knows what's going to happen in the stock market. It's the kind of risk that you take without any guarantee of future returns. But in order to further take that emotion out of the equation, there was a really good piece of research that was done from a company called Capital Group, which actually shows the probability of success in the market depending on how long you invest in it for. Now, the analysis looked at market data from the S&P 500 index over a 96-year period up to the 31st of December 2023. It also accounted for reinvested dividends, but it was not reflective of any commissions, charges, fees, or any taxes. And then it highlighted what your probability of success would have been over different time periods. And they concluded over any 1 year period, you had a 73% chance of positive returns. For a 3-year period, that jumped to 79%. Over 5 years, it jumped to 88%, and over 10 years, it jumped to 94%. All of a sudden, when I started to think in periods of 10 years or more rather than what was going on day by day or week by week, I wasn't too fussed about my portfolio fluctuating in value. Now, of course, there are many more mistakes that you can make when you're investing into the stock market, so be sure to go away and do your own research. Be sure to go and develop your own investment strategy and investment plan before you go on to make any kind of investment decision. And whilst you're over here, if you do want to see what my investment plans are for 2025, then be sure to check out this video next. Subscribe to the channel as well whilst you're over here. And with that being said, I'll see you over in the next one.